In today's video, we're going to be revisiting the credit card and bank transactions we've seen in the previous two. And we're going to be learning three concepts that essentially make up the backbone of all accounting and form the basis for all financial statements. And those concepts are journal entries, the general ledger, and trial balance. So up until today, we've only really looked at all of these transactions by using this columnar format. And this is good, especially for learning at the beginning, but eventually it's going to be getting too complicated. So we need to find a simpler way of recording transactions and making reports and so forth, because this is already at a full page. So this is getting complicated enough as it is, right? And for us to do that, we're going to be starting off with journal entries, because journal entries are kind of the source information for all financial statements and trial balance and so forth, right? So it's going to be the same transactions, so you should already be quite familiar with some of them, which I think will make the learning process a little bit easier. Okay, so starting with journal entries, before we get ahead of ourselves, there's a few rules we want to check. So kind of rules of debits and credits, and these are basics. I'd recommend you even kind of screenshot this or jot it down to kind of have it on the side, because you'll be referring to this lots, and we'll even be referring to this lots in this video. The first is debits equals credits, and this is similar to assets equals liabilities plus owner's equity. So all debits must equal credits in every transaction. The next is debits on the left, credits on the right. I think there's some accounting song out there singing about this, which is kind of hilarious. But anyways, debits on the left, credits on the right. We'll see what that looks like in a bit too. And then, okay, which account to use? Because a lot of people have a kind of, I already have an idea of what's a debit and what's a credit. I want you to try to forget about that for this video and just ask yourself the following question is, okay, is the asset increasing or decreasing? If it's increasing, we're going to use debit. And if it's decreasing, we're going to use credit. If it's a liability we're talking about and it's increasing, then we use a credit. If it's a liability and decreasing, we use debit. And equities is the same, right? Owner's equity. So if owner's equity is increasing, we'll use a credit. And if owner's equity is decreasing, use a debit. Okay, so just save that, have that on the side. We'll be referring to that as we go on. The next contextual piece I want to show us is the chart of accounts. So this is all of the accounts we've seen thus far. So nothing should really stick out to you because we've seen all of these, right? We've seen cash, Jen's bank account, investments, accounts receivable for that Euro trip her friends owe her money, her February prepaid rent, and so forth, right? So these are all kind of just organized chart of accounts. And the things to note here is firstly the account number, because this helps us keep everything organized when we start to build our general ledger, trial balance, financial statements, etc. So it's quite important of the kind of numbering system we use, right? For assets, you can see I've used a 1 for the first number. Liabilities, I use 2. Owner's equity, I use 3. Revenue is 4. And then expenses, I kind of switches a bit. And that's because at the current moment, Jen's life is mostly just employment and she has a bit of rental income, right? So you can see essentially the deductible or the actual expenses that Jenn could deduct or, expense on, say, her tax return, I've given the 6 starting. And that would be also where all the business expenses would go if Jenn starts a business at some point, which she probably will do, spoiler alert, at some point, because obviously she said she doesn't like her job. And then for all of the personal expenses, I put a 9, and I think it is important still to track these, even though you cannot deduct these on your financial statements or your trial balance or tax return, at least not yet, right? Because there may be, when Jenn does start her business, perhaps some of these personal expenses can actually be shifted into business expenses if they are legitimately used for business purposes. So that was just a note on the numbering of the chart of the accounts. All right, so that's good. Okay, so now we're going to be kind of flipping back. We're going to start off with our bank statement that we saw last day. So here's the same transactions we've covered, and we've kind of already talked about the increases and decreases, so this should be somewhat familiar to us. Right, so let's talk about this opening balance to start. And this one I've actually done the journal entry for us, right? So this is saying, okay, Jen's bank account, this is her beginning balance. So in order to account for that, we need to say, okay, now we're starting her accounting from fresh. Her assets are now going up, right? Her cash is going up. And we've seen that before in this previous discussion here. Cash goes up, equity went up as well. And this one was kind of a few things, but we're going to do one by one to make it clear. Right, so the journal entry will look like this, and I'm gonna, I've got the first one on, and then we're gonna walk through each one together. So some basic things every journal entry needs. The first is the date. This is important because our financial statements need to all be correctly categorized in particular dates. Journal ID, this one's also important. If you're using accounting software, this is usually done automatically for you, but this is kind of just so you can, search things up, or how each transaction has a unique ID. That's fine. A description. Description is pretty important because this helps your future self, or the future accountant, or whoever is looking at this in the future, kind of determine what this was actually for, right? So it's good to have good notes so you can have an idea of what that is. Account number, right? So this happens when you decide which account to use, right? This transaction affects two accounts. It affects cash, which is an asset, right? And then we can go back to our rules here. If assets are increasing, we're going to use debit, and debits are on the left, credits are on the right. So that's why you can see two columns here. One is the debit column, one is the credit column. Right, so we're satisfying pretty much all of these rules in the first transaction. Right? Debits equals credit, so these amounts of the transaction are equal. The debits are on the left side, right? The debit is there, credit's on the right. Assets are increasing, so the debit amount is for the asset, which is there, the 4380. And then the equity is also increasing, right? Because Jen doesn't have to pay this money back to someone. This is hers, then it is not a liability, it is her equity. So it's, if equities increase, use credit, otherwise use debit. And one other thing is, usually, it's not completely, but it's kind of just like accounting etiquette. Usually you put the debits first, and you don't have to, but usually you try to put the debits first just so things kind of stack nice and easily. Not a complete requirement, but I would recommend it. Okay, so let's look at the next transaction then, right? So this transaction here was a withdrawal. So Jen took money out of her bank account and put into an investment. And you might remember this one is, so the easy one, the easy thing to ask yourself at the beginning is, okay, what are you getting? What are you giving up? And since we know that this entire statement has to do with cash, we know that, okay, well, cash has to be affected, right? So in this case, we can ask ourselves, what is happening to cash? And we know cash is an asset. So let's talk about that one first. Right, okay, so cash is going down, which would be a credit. So I'm gonna throw in the account number here, and the information will sort of just pop up for us. Right, okay, so this is our monthly recurring investment contribution. We are having our date, our description, our account. This isn't completely necessary, but I've got it here to kind of drill our minds in on to see what happens. And we see that cash is decreasing, so we use the credit. It's on the right side, and we use the credit amount there. Okay, well, what are we gaining here, right? Are we gaining more equity? Well, not really, right? We're kind of trading in our cash for an investment, which is a different asset, right? So this different asset, if we look here on our chart of accounts, we can identify it as investment. So we can pop this investment in here, and our investment is going up. So this is just kind of a shift in assets. There's no new liabilities, there's no new equity. we have a shift in assets there, and that's good. Okay, so we've done 2 transactions, and we're gonna do some more, but I wanted to pause here to show you a couple other things. So one of them is this general ledger. So this general ledger is very helpful, actually. If you've taken any accounting courses before, you've probably heard of something called a T account. And this is essentially the detailed T account that you would see in accounting software, and it's very useful for reviewing because you can give it some inputs here. For example, if we give it the account number of cash, and we can filter for date. So we can say, okay, what's happening to cash between January 1st and January 31st? So far, we've done 2 transactions, so we can actually follow the bank statement exactly the same, right? This ledger should be the exact same balance as the bank statement so far, because we've got the debit on the left, the credit on the right. The net balance is now that 3.9, right? So this is the general ledger, and we'll be kind of flipping back and forth. So we'll be checking a few other accounts as well, because we can actually put in other accounts here. And as we update, we should be able to see, for example, the capital is sitting at this opening balance for the cash, and all of the information's there. We've just credited 1, right? So any negative balance here would be a credit. We've also got the trial balance. So the trial balance is something that is essentially the blueprint for all financial statements, and it's an internal document, and right now it's pretty bare bones, but by the end of this video, it will be more full. Right now, okay, what do we have? We have our assets, right? We have cash and investments. And this is essentially a snapshot, and this also filters by date, right? This is saying between January 1st and January 31st, 2025. Right now, we just have those 2 transactions that we've covered, these 2. So what is the ending snapshot at the end of the date if we were to only have these 2 transactions? Well, it's simple. Our cash would be this 3.9, and our investment would be 400, and our capital is the rest, right? And I know in previous videos we talked about, well, maybe there's more investments, and we'll be adjusting that later if Jen actually has more, but from the information we have, we can only decipher she has $400, so that is fine. Okay, so flipping back to our journal entries, let's continue. All right. Next one, we have the strata fee for the Whistler investment property. So again, the easy thing to think about is what's happening to cash, right? We are paying cash. So if we put the account number for cash, we can see that cash is going down. We are crediting cash, right? Well, what else is happening here, right? We have an expense, right? We have strata expense, and we have an account number here. I'll pop it in, 6501, and then let's take a look at what we think this means, right? So why are we debiting the expense? Because if equities increase, use credit. If equities decrease, use debit. So you might remember from the previous video that any increase to an expense, right, this decreases owner's equity. We did the same thing here with the strata fee. So we're doing the same thing here. We are debiting the expense because any debit is what we use for when we decrease the equities, right? And again, you could kind of back and forth. As soon as we enter that in, we can now see the trial balance, and it should all balance here. Total debits equals total credits, right? This has to balance. Otherwise, you have problems, but as long as we do all of our journal entries correctly, we shouldn't have any problem. Okay, that one's good. So the next transaction, this one's a little bit trickier because there's more than 2 accounts being used, which is totally fine. It doesn't have to be just 2 accounts. And this is kind of one of the rules it's called double entry bookkeeping or double entry accounting. Essentially, it just means that the debits need to equal the credits, even if that means there's like 2 debits, 1 credit, or 1 debit, 2 credits, so forth. Okay, so what are we getting? We are getting cash. So we can pop in the account number for cash, and our cash is going up by 10,000. That's good. But if you remember here, 2,500 is non-repayable, 7,500 is repayable. So that means 2,500 of this is actually kind of like an income. And you can see here we have this 4,100 grant income. So I'm going to pop that in right here, right? Because this is our equity is increasing, right? This is kind of like revenue, right? If you're getting money that you don't have to pay back, that's considered equity, right? Kind of like this beginning amount there. But there's the other component, and we could find that student loan payable, right? We have to pay back the other amount. So this will be account number 2,500, and this is now revealed here. And this is the liability that needs to be paid back, right? We don't have any information. Usually you don't have to pay back student loans until you're done your studies, so we don't really have to worry about any interest yet, but eventually Jen will need to, right? So again, liabilities go up, so we use the credit. We've got our date, we've got our description, we've got, account number, account name, and even the account type in here to really help us understand. So that is good. Okay, we've got rent here. So this is Jen paying her personal rent, right? So what is happening? Again, we are giving up cash. So we should expect to see a credit. And notice how I'm using the second line to do the cash. It's because, like I said at the beginning, every transaction should have the debit, then a credit. Like debits first, then credit. Kind of just following, just so it stacks nicely, right? It's really nice to see this whole journal report with that method. Okay, so what is this? This is rent, right? Rent expense. It is personal in nature, so let's see if we can find it here. Rent is 9,200, so let's pop in the account number for 9,200. This is Jen's personal rent paid, right? Maybe we can pause here to quickly see the, general ledger, how this is, the cash is obviously the biggest account we've used. So let's flip here to take a look at essentially the T account, if you remember that, your debits and your credits, and then your overall balance, right? So this is your increases and decreases, and we can see that match up to this exact amount there. So this is looking very similar to the bank statement, which is exactly what you want, and it makes your accounting very clean if you can make your kind of bookkeeping and accounting kind of mimic this, right? So we're doing a good job so far. And again, this is where you can see the journal ID stacking up nice and neat. That is good. So a very good place to look. Same for the trial balance. What is this looking like, right? Everything still balances. We're starting to get some, more liabilities, some income, and some expenses along the way. So what's next? Okay, we have the rental income, right? So cash, we are getting cash, right? If we are getting cash, cash is increasing. An asset increasing should be a debit. So let's put 1,000 on the first line here, and we're gonna debit cash for 2,070. And the other component of this is, do you have to pay this rent back to somebody? No, we don't. So this can be considered our, equity going up, but we have specific accounts for this. So instead of just putting it directly to equity, we want to be more specific, and we have an account called rental income. So I'm going to do that, and we call this revenue, right? Kind of like the grant revenue, and this way down the road when we build financial statements, or even looking at the trial balance, we can start to say, okay, well, what are our income sources? And let's compare each of them, right? And instead of just kind of baking them in, this tells us more information, allows us to make better decisions. So that's good. Okay, moving forward. All right, we have a payroll deposit. So payroll deposit, this is money going into Jen's bank account. Again, this is going to be a debit to cash. So let's go ahead and put in that 1,000 account number there. So that's good. Make that available. So cash is going up, And also we have an account called employment income. So that is kind of our revenue account that I'm going to type in here, 4,000. Right, this is saying that we received money. This is Jen's kind of after-tax amount for her payroll. We don't have to pay it back, so it will increase equity, but we do so using the revenue account. There it is there. So that is good. Let's go with, okay, credit card payment. Credit card payment should look like, okay, well, we know we are giving up cash. So again, the easiest place to start is we will credit cash for 2,500. And what do we debit here? We don't debit an expense, but we debit a liability, because when you pay your credit card down, essentially you're reducing your credit card payable, right? So we're going to put in the 2,100 here. And this is our liability going down. And eventually we'll get to the credit card entry itself, but it won't take us that long because we did most of the heavy lifting in the last video, kind of analyzing and looking through the credit card report, right? So this is a reduction of a liability. So we debit, right? If liabilities decrease, use debit. So that's fine. Tuition, we are paying money and we are incurring some sort of tuition expense. It is personal in nature. So let's see if we can find some sort of educational expense. I see that there. So we can, start with the debit since we know it's an expense. This is education, personal, and this is related to, or also going to affect our cash. So we can put 1,000 here. Like cash goes down by 2,500. Okay, that is good. What is next? Okay, service charge, right? We lose $15, so we credit cash for $15, right? So I'll put our cash credit, second line, right? Cash goes down and we have another expense. So expenses decrease owner's equity, and we should have some sort of, bank fees personal, right? So let's throw that in there, 9,400. So we have our bank fees personal being used there. So that's good. Next transaction, we paid rent early, right? So this one, okay, well, let's talk about what are we giving up first? We are definitely giving up cash. So let's pop in that second line of 1,000, right? Cash goes down by 1,950, but this is not an expense because this is for next month's rent. So this is where we actually use the prepaid account, right? We use 1,300 and we're not going to actually expense this until the following month, until February, because this payment was in fact made in January. So we're not going to worry about adjusting this entry until the end of February. So here we just have another shift of assets, kind of similar to up here where we're exchanging cash for investments. Here we're exchanging cash for prepaids. So that's good. Okay, payment again. This is now, we've seen the exact same transaction. So cash should be going up. So we debit cash for 1,608. And we're going to credit employment income. So that is an increase to equity. That's good. Next we have two more transactions here, another credit card payment of $3,000. So let's put that in. We give up cash of 3,000. So cash is credited for 3,000. That's good. And then remember, this is not an expense. This is a reduction of a liability. So this will be a debit, right? Maybe I need to pull this down a bit so we can continue to see that. That's good. Okay, that journal entry is looking good. And just a few more to go on the bank statement. So last one, this HELOC payment, right? This one was a little bit more complicated if you remember back from last day, we covered it, a component of it was to do with interest and a component of it was to do with principal. And I kind of walked through the calculation being right here, so I'm not gonna redo that walkthrough. But we just need to worry about how do we correctly record the journal entry. Okay, well, we know we're giving up cash of 1,500, so cash goes down. We're gonna credit cash 1,500. And this is gonna affect two other accounts, right? So we're firstly, it doesn't actually matter which account we do first, but let's do the interest first. So let's find the interest here. And you'll notice this one is related to the 6502 line. So it's not personal because this interest would for sure be deductible on Jen's tax return, right? So we want to separate that because we definitely want to take advantage of that. Otherwise, Jen's going to be paying too much taxes. So we debit the expense because the interest, any expense, will reduce our owner's equity. And the remainder goes to this 2,400 account. And that is related to the principal that's being paid off. So that is good there. Right, so now we should have a general ledger is totally filled out. We've done 14 transactions, quite a few, and this pretty much matches, right? And this is interesting because this is not the bank statement. This is our accounting records, right? And it's exactly what you want them to look like. We've got kind of our T account of our debits and our credits. Our opening balance matches that 4,380. Our ending balance matches as well. So we're confident with cash. And this is something that you could do on kind of a regular basis, whether it's monthly, quarterly, ideally at least quarterly, so you can have a good sense of what's going on. We also have a trial balance now, right? So this trial balance has a lot of stuff on it. We've got our kind of assets, $7,000 worth currently. Our credit card payables and a giant debit balance because we need to kind of update some of those other transactions we'll do shortly. Same with our loan payable because we're missing those kind of opening balances here, which we'll add in a second. But this paints a little bit of a picture, right? We've got some income. We've got some expenses, and let's continue on with our transactions. There's not too many left. The next one we're going to call our opening balance true-ups. And what I mean by that is, if you remember last day, we had our apartment, right? 650,000 was the apartment. And this needs to be entered into our financial statements or for our financials. So what would that be from a journal entries perspective if we think about it? Well, the apartment's an asset, and getting an asset that you don't have to pay back, well, you have to pay back some of it, which is we'll deal with separately with the HELOC, but this is an increase to equity. So we're going to see both. So let's just grab our account here, building 1,400. So let's put that in 1,400, building. So this is kind of, you can say, to true up the fair market value of the apartment, essentially to get it on the books, right? We need to get this on the books. And then the account it will affect is going to be your equity account, that 3,000 account, right? So now our trial balance and even our general ledger, if we change this to 3,000, this is going to start to paint a little bit more of an accurate picture. Going to the trial balance, now we've got that asset in, capital has also gone in, so that's good, wonderful. Okay, next one is going to be the credit card, right? So you might remember the credit card, we had an opening balance of 301, right? This was kind of from previous year's expenses. That we've expensed it, presumably, but we still have to pay it, right? So what is the journal entry to true up that balance? We are going to debit our equity account for 301, because this is a reduction of equity. This is, things that had been expensed and money that we now owe. And we are going to credit our credit card payable, right, 2,100 here. and that is an increase of a liability. So that's good. I think we have one more though. We have the HELOC balance. So we need to get this amount in. This is the amount owing, or the remaining amount owing, of Jenn's apartment, the investment property. So we're going to go here. Again, this is going to be a reduction to equity, because now we're saying, okay, well, we had this big asset, we increased our equity of 650, but we actually have to pay back some of that. So not all of this apartment is equity right now. We are actively paying it down. We have a loan, which is a liability. So let's use that HELOC account 2400 of 86,071. And now when we look on the trial balance, we should see some more accurate figures here. Yeah, so this is kind of up to the end of video 1, I think. So here's our loans and our debit for credit card, because we haven't included the purchases, which is fine because that should be pretty quick for us. Okay, so this is good. So all we have left is the credit card statement. And if you remember from our previous video, we sort of did a bit of we went through it in detail, so I'm not going to go through it in detail as well. And I summarized it, making this. And the only thing I've added now differently is I've added the account numbers so we can easily incorporate this into our financial journal entries, right? So essentially what we need to do is, okay, well, what would this transaction be? Right? All of these were expenses, right? And all of these expenses should be going up. So we expect a debit, right? So let's go ahead. Should just be able to copy this and let's see if I can just copy that in to the account here. Let me try revealing all of this and let's just do a check. I think the first one should be the accounts receivable, actually. So it's going to be starting on the first line will be the accounts receivable. So let's do that. Because yeah, that's the 1,000 there. So that is our asset. And then the second line, starting at the second line, will be all of these. And then the last line should be your credit card payable. And let me put that in and then we can take a quick look at it, make sure we understand, because this is probably our most difficult transaction, but let's just pause here for a moment. Okay, so this was saying we purchased, or I guess all of these amounts is 486289 on our credit card. And this, if you go back, I remember we looked at this, there's the 4862 of purchases, right? So all of that becomes a payable. So that's why on the journal entries, we increase the expenses. So we debit all the expenses. We debit the asset because the asset's also increasing for the amount that the friends owe for the, portion of the trip. And then also we credit the credit card payable of that full amount, right? So now I think when we look at the trial balance, we should see a more, so this was exactly 335.32. I think that should be exactly what we saw right there, 335.32. Okay, so that's good. The credit card is in a kind of positive balance, right? Because this is saying we overpaid our credit cards. We kind of have it's not really an asset, but we have, up to 335 of purchases that we could make without even needing to make a payment on our credit card. And this is kind of common in real life. I know I've done this a few times where you overpay your credit card and you end up in a little bit of a credit balance. All right, so this is looking pretty good. So we have our GL, right? So let's maybe toggle through some of the accounts we've seen. Which ones did we touch lots? So maybe credit card payable, if we change this to 2100, we should be able to see kind of all the transactions that affected the, there's the credit card payments, the true up amount. This probably should be sorted by date, but that is fine. And our ending balance, which we've seen before, that's good. Equity was a good account to look at. What is our transactions affecting equity? We've got our kind of true up opening balances to kind of get the old things on the books. And then we've got, essentially all of these are true up opening balances. We've got our employment income, right? That's fine, that looks good. This is a pretty good GL. Kind of the last step that we'll give you a bit of a teaser for is, okay, well, actually, where are these amounts coming from on the trial balance? And maybe you've seen it already, but if you look at this account, for example, so 4,000, and this is kind of our ending balance, right? Our ending balance is kind of the running total, and that's going to go back to this, right? Same thing for that equity that we just saw, or cash, everything. So the trial balance is, we call that a snapshot at a particular point in time. So there's that 5, 6, 7, and there's the, the ending balance. And this, of course, is sorted by date, right? If we start changing the dates here, we're going to see future transactions in February and so forth. So it's very important to have your dates filtered appropriately during this, right? So all of these ending balances here are the final ending balances for those accounts. And most of them only have like one account being used because we've only done 1 month of operations. But as the month goes by, we'll be seeing longer lists in the GL. Right, so just to kind of wrap it up on how this kind of ties everything back, let's just do a quick Excel check here, right? So our assets, right, is these accounts, the stuff in green. So it's 5,658,804. We've seen that number before, should be approximately exactly that. So that's good, right? Our liabilities. So what are our total liabilities? We've got this plus this, and actually minus this amount there. So 92,355, right? And we've got our owner's equity. Could really be all of these things. I don't want to get too ahead of ourselves. Next time we're going to look more into like financial statements. So I'm going to kind of add all these up separately to kind of show you. So we've got our opening equity plus our revenues. So I'll equal sum, and I'll add these revenues in, and then minus our expenses. So minus all of these up to here. And hopefully this gives us a number we are happy with. So our assets plus our owner's equity is, these match. So assets equals liabilities plus owner's equity right there. It's not the cleanest looking, but next time we'll be doing kind of more detailed taking our trial balance to the balance sheet, the income statement, statement of owner's equity, and so forth. But this gives you hopefully a taste. And like I said, the trial balance honestly is probably the most useful statement, right? If you can look at a trial balance and kind of grasp what's going on, you are going to be fine, because this tells us all the information, or pretty much most of the information that's going on, all of the financial statements. So the income statement, the balance sheet, and statement of owner's equity. All right, so this one's a little bit longer of a video, but we covered a lot of stuff, so I hope it was helpful. And we're gonna see you in the next video, and eventually we're gonna be exploring more transactions, finishing, if there's anything left to do for January, and continuing along Jenn's financial journey for the year. So thank you, and see you in the next one. Bye.